This is the June 6th edition of Commodity Week.
Todd Gleason services are made available to WILL by University of Illinois Extension.
Well, welcome to Commodity Week. I am Todd Gleason. Our panelists for the day include Naomi Blohm. She's at Total Farm Marketing. Greg Johnson joins us from TGM. That's Total Grain Marketing. And Arlan Suderman is here from StoneX. Commodity Week, of course, is a production of Illinois Public Media. It's public radio for the farming world. Find us online at willag.org, willag.org. There you can listen to our programming anytime you'd like, on demand. Just click and play it from the website or hit that link that says podcast, and you can subscribe to Commodity Week, our daily closing market report, and the Illinois Nutrient Loss Reduction podcast. Let's begin our program this way. I'll start, Arlan Suderman, with you from StoneX. On Thursday, the market jumped. I was told during the closing market report that there was some information about taxes out of Brazil that made this happen. What have you heard, and what else do you think's going on?
Yeah, I feel like maybe I should be total StoneX marketing here to keep the theme going. But what it boils down to, give a little background, is Brazil's Congress passed a tax cut bill, and that kind of upset the administration in Brazil. So they, by executive order, decided to close a tax loophole that equaled a similar amount. So that goes into effect immediately and is essentially a tax increase. Even though they say they kept the tax rates the same, it's essentially a tax increase on corporations in Brazil. And so that makes those corporations less competitive. Now, from an exporter standpoint, they have such an advantage because of cheaper currency. They're going to continue to export. I don't think that changes anything. In fact, it may actually increase their exports. That's something the market is actually, I think, ignoring. But from a crusher standpoint, a biofuel producer standpoint, this makes them competitively less competitive, shall we say. And so the market is assuming here, and I think there's some truth to it, that it will make their processors, their crushers, less competitive on the world market, and therefore decreasing their demand for raw soybeans, raw corn. That would be expected to weaken basis, kind of offsetting the disadvantages that the exporters have and maybe increase exports. But shifting some of the crush activity, soy oil, soy meal, product supply on the world market to Argentina and the United States, as well as some of the biofuel activity. That's the assumption the market is making. What's interesting about this is executive orders go into effect immediately, but they have to be approved by Congress within 4 months to stay valid. And so if Congress says, we don't like what you did trying to upstage our tax cut, they cannot validate it, and this will be a short-term thing. But if Congress says, oh, okay, our tax cut was for individuals and you're going to raise taxes on corporations, we're fine with that, then they may go ahead and validate it, and it'll be more permanent. So the story isn't over, but for now, it certainly would seem to take away a little bit of a competitive edge that Brazil's had.
I get what you told me. I understand, I think, why you believe this is going to put more exports into the marketplace. How is it that the trade misread it today?
Well, I think the focus out there has been on the competitive disadvantage it gives to the crushers and to the processors. And so therefore, that means that some of that business for soy meal, soy oil, as well as biofuel will shift more to Argentina, United States. And the exporter will still face the same tax penalty, but still be able to pass that on because they will likely be able to buy a little cheaper because it's a downward pressure on basis within Brazil, and because the exporter still benefits from a tremendous advantage because of currency exchange rates. And so therefore, I think the exporter will be able to pass on the costs of the added tax costs that they have, whereas the processor and the crusher will not be able to the same extent. But the market has been focusing because most of the focus has been on the crush industry and the biofuel industry.
I see. So what you're saying is the market's got it wrong, at least at this point, and they may have to recognize that the crushers and the ethanol industry may actually end up pushing more exports out. Does that change anything? And is this the way you see it too, Naomi Blohm? Does it change the scope of what you've been thinking about for those 7 previous days beyond Thursday, where the market was lower for corn and soybeans?
Well, I think to Arlan's point, this might be something of a shorter term impact. As Arlan had indicated, there's potentially a 4-month process here to get that approved or not approved. So in the meantime, what it did for today was put the brakes on the sell-off that we've had, and we had November beans dig in their heels at that important 1150 support area. The other thing that the market is starting to wake up to is how much acres are not planted yet in North Dakota and in Minnesota, and it's to the tune of nearly 4 million acres, and their prevent plant date is coming up next week. So between these two things, along with the market being oversold technically, we got the brakes put on the market. I think we see a recovery bounce, but then it's going to be up to Mother Nature and these USDA report that's going to be out next week. So when I look at these charts now, I'm thinking, all right, are we going to actually have enough friendly news between these items here to resume an uptrend, or are we putting in a right shoulder of a head and shoulders formation on a chart? So the bottom line, though, hey, producers, you got yourself a nice little uptrend here going potentially here for the next few days. So take advantage of it for some further cash sales.
Okay, Greg Johnson, you and I on Wednesday talked about Fibonacci numbers a little bit in the soybeans and the corn, both. I know you've also thought some about the number of acres that are around and not planted and what that might mean. Is this just a reason to stop if you've been the downward movement in this marketplace, take a breather and bounce?
Yeah, I think a lot of this was technically related. When you don't have a lot of fundamental news to talk about, you go back to the charts. And we rallied 50-some cents in corn, and Fibonacci retracement is 61.8% of that, or about 34 cents. Well, guess what? That's about how much corn came down off of its high to the low yesterday. And miraculously, today we bounced. So I think there were some people that looked at the charts and said it's probably time to buy some corn, at least in the short run. And the same way in the beans, we had a $1.10 rally from the March lows to the mid-May highs. And if you take 61.8% of a $1.10 rally, you get 70-some cents, and that's exactly what we lost in the beans. And so I think you just had some people looking at the charts, and you need something to spark it. And it might have been, the news out of Brazil, as Arlan was saying, that might have been the spark. But then you throw a little bit of technical, buying on top of that, and combine that with the fact that the farmers are in no mood to sell this early at these low prices. If you were at $5 corn and $12 beans, maybe the farmers would sell. But at these prices, lack of farmer selling, a little bit of technical buying, and a little bit of possibly friendly news out of South America, and we've gotten our rally.
For that matter, they're in no hurry to sell the grain that they already have on hand either, it appears. And they haven't been for a while. So the question then is, are farmers right now on old crop, and should they wait, Greg, for a bit more for this to rally and have an opportunity to make up some of the interest and carrying charges that they've accrued over the last many months?
Yes, I've been on your program many times, and I've probably been accused of being probably the most negative person on there. And big picture, long term, I still am. I think we'll see lower prices, assuming we have rain in July and August. But here in the short run, I guess I'm a little friendly. I think that we're 5-6 weeks away from people looking at the pollination forecast, and that some of the corn got planted wet in wet soil, so the roots won't have to go down. So The last 2 years, the roots have gone down, and when we get some moisture in July and August, the plants have been able to take advantage of that. This year, we better be getting rain about every week or 10 days. Otherwise, we may see some problems. And I don't know that we will. I'm not saying that we will. I'm just saying that the market tends to move based on weather forecasts. And I think there's enough uncertainty that we're still good for one more pollination rally. I think the planting rally has come and gone, but I think we can see a pollination rally. I think we can get back to the old highs. 475 on July corn. We're about 23 cents away from that today. I don't think that's asking too much. And beans, another 30, 40 cents. I think we could probably see that. So in the short run, I'm friendly. But again, big picture, farmers need to take advantage of those planting rallies, those pollination rallies, those technical rallies, whatever causes the market to rally, because the fundamentals would still argue that we're going to have something close to a 1.8 billion bushel carryout in corn and a 400 million bushel plus carryout in beans. And that does not argue for higher prices, in my opinion. So take advantage of the rally here in the next 4 to 5 weeks if we get one, and have your offers in and be ready to pull the trigger.
Okay, Naomi Blohm, so you were, I think, building a friendly picture potentially too. Is yours more short-term than long-term for corn?
Yeah, like you got 3 days. That's about it. So I know Naomi's not friendly. What? So here's where I'm at with this. I'm seeing on these charts, these corn specifically, we've got a 2-year downtrend line that we are going to be bumping up against hard, and that's going to come in between 475 and 480. Now, as time has passed, obviously the trend line has come down. And so that recovery bounce that we can get here over the next few days into next week, Wednesday's USDA report, I feel may be as good as it gets in the short term. And we're going to have one heck of a time seeing December corn futures climb above and close above 480 or 490 to try to buck this 2-year downtrend line that we've been dealing with. So my thought and my encouragement to producers is, as Greg was saying, we're still dealing with 2 billion bushel carryout, and we have to see a big significant shift in acres or some dramatically hot and dry weather to occur in pollination to buck that mentality. And when we look back at historical levels, when we have years where we have 2 billion bushel carryout and it's projected to go through until the next year, prices really struggle to gain in any capacity. And those are the years where we saw prices more hang out near $4 or $3.50. And if this head and shoulders formation comes to fruition, the downside objective that I'm looking for is $4.20 on December corn. So I'm always of the standpoint of, Mother Nature's in charge, and if the weather really turns out to be hot and dry in July, that's a game changer. But in the short term, we are dealing with 2 billion bushel carryout, and that's really burdensome for the market for right now.
And Arlan, your thought on the situation?
Not a lot I disagree with there. I'd say another factor in this is that the corn-wheat spreads had really gotten out of whack, and I think that was another factor that kind of supported the technical buying that we saw. I think the most intriguing thing here that may give us some opportunity from upside, and I tend to fall in the camp that you need to take advantage of rallies because we're still looking at stocks that are adequate here to meet demand, is the story in Russia on wheat. If, in fact, this does turn out to be a situation where Russia starts restricting exports in order to avoid social unrest there with high bread prices, and we've already had some government officials in Russia raise the food inflation flag, then you could see some real excitement in the Chicago wheat market. Keep in mind that the statistical correlation between Chicago wheat prices and U.S. supply and demand fundamentals is very weak. It's stronger for European and Black Sea fundamentals. The funds tend to trade Chicago wheat based more on those fundamentals than they do our own. So if, in fact, we do see exports restricted out of that region, suddenly the market starts looking at stocks-to-use ratios in the other major exporting nations being rather snug, and we see a quick rally come back to 2010 where we doubled Chicago wheat futures in 5 weeks' time, and then it collapsed. that could take corn with it. So if you're saying, okay, what kind of scenario could take us higher that we don't currently see, that's one of those scenarios. Outside of that, I agree, rallies are meant to be sold, and we're going to know a lot about this Russian wheat market here over the next 2 to 3 weeks.
And follow up for Arlan, I'm so sorry, but that was my next question, was if they do the cutback on exports, is that going to show up in 2 to 3 weeks, or does that show up in a longer time frame? I'm just trying to know what I'm watching, engaging, and calendar monitoring.
Yeah, ordinarily you think, well, that would show up in inability to exports in the last half of the marketing year. But Russia would have an incentive to get ahead of this because exporters would, of course, they're nationalizing the export industry more and more to have more control over that. But still the tendency is to get stuff out the door as quickly as possible before any restrictions are on. Mm-hmm. And Russia would probably want to get ahead of this because you have farmers there saying, well, we think price is going to go higher, we're not going to sell, and that just kind of elevates the market. And so probably as we start to get more of an indication of what production actually is, because the crop is maturing ahead of normal, we'll probably know something sooner rather than later.
Thank you.
I have a question about this, too. This is a political question, Arlan, and I think you'll be best suited to answer this one. I believe it was 2010, the last time that they restricted, embargoed, and I think was the word used then, wheat exports. However, that, if you connect the dots, may very well have tipped off the Arab Spring in the Mideast, which was a bread-led or food-led democracy movement. Do you think they would be willing to do that again?
Well, their number one priority for President Putin, is to stay in office, to survive politically. That's his number one priority, and he already has the problem of body bags coming back from the war, and he's been able to kind of hold things together. But if you add food prices to it, it becomes a greater challenge to do that. So I think that's his number one priority. And so does he want to see another Arab Spring, particularly with the Arab countries joining the BRICS coalition, which is part of his power base now, along with China? No. But the number one priority is staying in power himself.
Okay. So if that's the case, is there upside potential then for a wheat-led market to continue?
Yeah, absolutely. And I think it would tend to pull corn with it to some extent. And so that's something that we have to respect. And again, it's one of those things, unless you have a legitimate weather risk to corn, you need to be active in selling that type of a rally.
This brings me to crude oil, relatively speaking. OPEC and OPEC Plus meeting on Sunday of last week. And Greg, I guess I'll come to you with this. They have continued to limit their production, and they extended those limits into the end of 2025. That's likely to hold the price of energy in general higher, crude oil particularly. Is that supportive to the corn/ethanol market and the soybean/renewable diesel biofuels marketplace?
To some extent, yes. But the bottom line is ethanol demand is dependent upon miles driven. And so just because they curtail their production and oil prices go higher, that doesn't necessarily translate to a lot more demand for ethanol. To some extent it does, but the better correlation is the more miles people drive, the more gasoline they use. We blend 10% ethanol with every gallon of gasoline, and there's your increased demand for ethanol. So artificially cutting the supply to raise the price is not as good as raising the price due to a driving demand. I guess that's how I would answer that question.
I asked that question because I do want to point people back to the closing market report from Thursday of this week on the 6th day of June. You can find that at willag.org. You'll have to get into the podcast section, but it'll be there. And I talked with an analyst from Kepler. His name is Victor Katana. He's based out of Vienna, Austria, a lot about crude oil, and he actually specialized at one point in his career in the Russian crude oil pipeline and LNG pipelines that run through Ukraine. And so it was a very interesting conversation, a discussion about the two canals too, the Suez, which he thinks the media has neglected it to cover, that it's simply closed for the most part, in his opinion. I don't know, Arlan, whether you have an opinion on that one, or maybe Naomi or not, but it is a good listen, and I encourage you to go take a listen to that. It is outside of the commodity markets, relatively speaking, but I always think of crude oil as the master energy, and if you think of food and feed just as energy, it gives you a different kind of tone and feel for the marketplace. But let's deal with commodity prices and what farmers are facing at this point. How much property, land, do we think, Naomi, has yet to be put in the ground in Dakotas, Minnesota, and how much of and can they do it? Do they have enough open time in the next week and a half? And then, of course, prevent plant doesn't mean actually that they're not going to stop planting. Will they continue to plant?
So right now in the Dakotas, what we're looking at based on Monday's crop progress ratings. So on that report, we saw that 20% of the 7.5 million acres that Minnesota is expected to plant into soybeans, 20% wasn't done. So that's 1.5 million acres that still needed to get in the ground. And when you look at North Dakota, 34% of their 6.9 intended million acres are not yet planted. So that's 2.3 million acres that need to get planted. And a lot of my clients in those two states have just been inundated by rain, and they had more rain yesterday. So it's going to take a couple days to dry out. Some of those fields will absolutely be able to get planted, especially as the forecast is turning a little warmer and drier. But then there are some that are really ponded and not draining, and we will see prevent plant in those states. So that's what the market's going to be watching over the next week to 2 weeks to try to get a handle on how much of that crop is easily going to get planted, what's going to get mudded in, and what are they going to wave the white flag on and say prevent plant. And of course, we'll get an updated adjusted acreage number on the 28th of June, but that doesn't, to my knowledge, include all of the prevent plant data, but it should show a little bit of a shift in acres. Again, bottom line, the market needing to put some weather premium back into it. I feel like we're starting to see that. But if we start to head into the end of the month of June and the weather forecast for July looks lovely, it's going to be hard for the market to really respond with higher prices. It's going to take something really dramatic in terms of hot and dry to get the market to respond with any gusto or flare.
Arlan Suderman, on the acreage, USDA's prospective plantings report, in its calculations, and it doesn't really say how much or how they put this in, but it does include prevent plant acres. So it's expecting a series of prevent plant acres that just aren't included in what we see as a number for total acreage. Do you think that this will push very much, this season that is, a change in what farmers have put into the ground and what the expectations might have been or are at this point?
Yeah, my interaction with fund managers and stuff, it's hard for them to grasp as a factor that they trade. We go to 2019 when we had almost 20 million acres of prevent plant, but yet we didn't see, is 19 and a half, I think, but we didn't see a 19 and a half million acre reduction in acres that were actually harvested. And then you look at the long-term average of prevent plant acres, 3 to 4 million acres, and they look at this and they say, well, that's just par for the course. And I think that's why, as Naomi said, they tend to trade yield more than they do acreage, because that's something that's easier for them to grasp and to focus on. So I think it's difficult, as frustrating as that is for farmers, it's difficult to get the market to focus on the prevent plant story. And, the June 1 survey, farmers tend to be optimists, and they tend to think, I'm going to get it done until they don't. And so that's slow to show up in the numbers from USDA. And I'm not as optimistic that we're going to see it show up in the June 28th report, because overall farmers tend to say, well, I think I'm going to get it done. And so they answer the survey accordingly. And then you get the June 28th report, and then USDA comes out and says, well, I think we're going to resurvey. Results will be in the August WASDE report. And so it just kind of keeps this doubt hanging over the market on acreage. And again, the funds tend to focus more then on what are crop conditions.
What do you think about potential yield at this point? And I'll start, I think I want to hear from all of you, but USDA has a 181. That's their trend line yield. Has it changed very much, Greg? Not the trend line, but have we come off the trend line, in your opinion?
There's two schools of thought. I'm the school of thought that I start in the middle, and then that way I can either go up 3 bushels or down 3 bushels. USDA and others start at the very max and can only go lower. It never gets better than 181. It never gets better than their initial number. It only gets worse. So I'm using 178, but I'm not saying we can't have 181. I'm just saying I think it's more likely that it's 178 plus or minus 3 bushels to the acre versus 181 plus or minus 3 bushels to the acre.
I'm going to say that the USDA is going to be more right than wrong this year, just because of the amount of rain that we have had, and the soil is charged. And we know last year, with as dry as it was, that with a few timely rains in July, we pulled off 177.3 for corn yield. So we're starting the season a little bit better than last year. We're not seeing the drought monitor index the same. So Greg's point is right on. The USDA is going to start high, and then it takes them a while to come down. But with as good as a start that we've had, it probably doesn't show up until an August USDA report if they're going to make any changes to the downside.
Yeah, we've had 4 or 5, 5 years in a row now when we've had kind of flat yields, and USDA's had to come down. But prior to that, it was the opposite trend. And that's kind of been the pattern of late. So are we now going to shift into that where they're higher than expected? I don't think we can rule out something above 181. I was starting to pull back from that 181 because I was looking for a good to excellent on the corn crop to start off at about 67%. Because of some of the excessively wet areas, and lo and behold, we come in at 75%. So that makes me really reluctant right now to pull back. The bottom line is USDA is going to stick with 181 in this June report. And unless some more significant changes, I think they'll even be at 181 in the July report. And so the market's going to trade 181 for a while now until we have more data.
It would be amiss if I did not include the University of Illinois agronomist in this part of the conversation. They wrote an article this week in which they asked the question at the very end of the article, does the start of the season predict yields? And they say the quick answer is no. The earliest start to the growing season ever, by the way, in this state was 2012. Rains returned too late for any yield in a lot of fields. In contrast, a major rainfall event, they write in early May of 2017, caused very large amounts of replanting, yet that was the first year that Illinois corn yields exceeded 200 bushels per acre across the state. So, as you've all said, we'll probably deal with a 181. Let's get a final word now from each of you about this marketplace. I'll start with Naomi Blohm. She is at TotalFarmMarketing.com. Naomi?
Yeah, so my biggest message to producers just continues to be, remember the seasonality of the marketplace for corn and beans both. A lot of times the 5-year, the 15-year pattern suggests that our last summer hurrah actually comes right around June 18th or 19th, barring some dramatic weather issue in July. So as optimistic as we all want to be at heart, I think you have to be realistic with what the market is offering you right now, and it would take something major of an outside market influence like Arlan was speaking of regarding something happening with Russia and wheat in order to get the market to go dramatically higher. So keep your price points and perspective in check. And not only thinking about the 24 crop, I would be also considering the 25 crop and starting some sales there as well.
And Arlan Suderman with StoneX, and we'll go with, StoneX, however you want to put it.
Let's not forget that the Brazil farmer still has a lot to sell and is undersold. But I also want to throw in there that 6 months ago, we were looking at the data and saying, okay, the funds have massive short positions, and in reinflation situations, they're uncomfortable with that. And I thought, how in the world are we going to rally this if we have abundant supplies? But yet that's what our studies were showing. And lo and behold, late April, early May, that's exactly what we did. We got this big rally. So the market does change the level at which it manages supply and demand, depending on whether we're in an inflationary or disinflationary period of time. That will have some influence. That doesn't mean that we are going to be at $8 corn by any means. We saw a good example in the crude oil market of the big rally as they flipped their positions, and then they corrected sharply lower, but stayed at a little bit higher level than what they otherwise would have been. We've seen that same thing in corn and soybeans. And I think that really kind of tells a story. Now, as we're managing supply and demand with some reinflation concern there, but that doesn't mean that we're going to really high levels. It just means that we've kind of put a little bit of a floor underneath of us until we start worrying about deflation again.
And Greg Johnson of TotalGrainMarketing.com, your final word.
Well, the farmers have not been selling the last 7 days, so that freed up some time for me to do a little bit of research. I was looking at the range in prices from high to low over the last 10 years for both corn and beans, and the average for corn is $1.40 from high to low. It was as narrow as only 70 cents in 2017. It's been as much as $2.10 range from high to low in 2021 and 2022, but on average $1.40. This year so far, we've had a 50-cent range. So I guess my point is we probably have a lot more room to trade ranges. Now, that could be higher highs, or it could be lower lows, or it could be a combination. But I just think that we haven't seen the weather part of the market yet, and it wouldn't surprise me to go a little bit higher. But again, eventually we could make new lows and get to our $1.40 price range from high to low. As far as soybeans, $2.50 has been the average range from high to low. It's been as narrow as $1.50. In 2019, it's been as much as $3.50. In what year was that? That was 2021. So $2.50 so far this year. We've had about a 95-cent range, $1 range in beans. So I guess my point is expect more volatility and be ready to take advantage of that, because we can go higher, but we also can go lower.
Commodity Week, of course, is a production of the Illinois Public Media. You may listen to the whole of the program anytime you'd like at willag.org, willag.org. Our thanks go to our panelists this week, including Greg Johnson. He's at TGM, that's TotalGrainMarketing.com. Naomi Blohm from TotalFarmMarketing.com, and Arlan Suderman with StoneX. I'm University of Illinois Extension's Todd Gleason.